Okay, guys, so in this video, we're going to talk about how to read a stock quote. So whenever you're basically checking stock prices online, whether it be Yahoo Finance or you're using your trading app, whether you're using Robinhood, Webull, Fidelity, Schwab, TD Ameritrade, E-Trade, or if you're using maybe an app overseas, if you're using something like Revolt or eToro or something like that, you're going to come across the quote. So, I'm just going to go through this information really quickly, show you guys exactly what all of this stuff means and what to interpret when you're checking a stock market quote. So you're getting some information out of the numbers that you're seeing. So let's just start off right quick. So the best example of this, let's use the most valuable company in the world, Apple. So let's just start right here. So basically, whenever you type the ticker, so for this example, I'm using Yahoo Finance. I like to check a lot of stuff on Yahoo Finance. I really like using their statistics tab and their conversations tab. And I'm going to go more in depth into Yahoo Finance in another video. But for this video, I just want to focus on how to read the quote. So what is the quote? So the quote is basically the basic information that you see here on the summary page. So let's just go over each one really quickly. So the previous close. So the previous close, that is the price that the stock closed at in the last trading session. And then for US markets, the trading session ends at 4 o'clock p.m. Eastern Standard Time, New York time. So that was the price in the previous close. The open is the price at 9:30 Eastern Standard Time, which is New York time. So it opened at $450. The bid. So the bid is basically the bid and the ask are the two ways that how a stock price is determined. So when someone wants to buy a stock, they make a bid, and then when someone wants to sell it, they make an ask. So as you can see here, um, the bid is basically telling you how many shares someone is how many shares someone wants to acquire and the price they want to acquire it at, and the ask is how many shares someone wants to sell it. So right now, since the markets are closed when I'm recording this video, these numbers are zero, but you'll see these numbers appear in pre-market trading and during trading hours, and that can kind of help you figure out how many shares people want to buy and how many shares someone wants to sell. The day range. So the day range is the lowest price that the stock traded at and the highest price that the stock traded at. So a lot of day traders use this information if they're looking for support, which would be the low end of 440, and then the resistance would be 455. So if you're looking to day trade things like that, you can nearly, buy just above support, sell near resistance. The 52-week range. The 52-week range, this is the lowest stock price over the last 52 weeks, over the last year, and this is the highest stock price over the last 52 weeks. So as you can see here in this example, Apple is near its 52-week high. The volume. So the volume is the number of shares that were actually traded in one session. So at the end of this current session, there are over 53 million shares of Apple stock traded. And the average volume is the average trading volume. I believe it's over the last 30 days or so. So that is just how many shares of Apple stock have been traded over the last couple of weeks. So in this example, the volume is much higher than average, which is a usually it's a very bullish sign, meaning that more people are getting into the stock and that the volume is up. And that's something you definitely want to look at. If you see a stock that's trading much higher than its average volume, usually that could be a good sign to get into the stock if you're looking to swing trade it or something like that. The market capitalization. So the market cap, that is stands for the total value of the entire company. And the way we find the market cap is we simply take the number of shares outstanding and then we multiply that by the stock price. So that's the market cap. So a lot of people like to use the market cap when they're kind of figuring out how much the total value of a company is worth. If you were to liquidate every single share, and in this case, Apple would be worth about $1.9 trillion. And it looks like Apple is going to be the first $2 trillion company ever. So really interesting. So the beta. So this is something that a lot of people don't talk about, but the beta is basically the the amount of like volatility away from the S&P 500. So the S&P 500 is kind of like the benchmark for the U.S. stock market. So the beta of the S&P 500 would be 1. So the fact that this beta is higher than 1, it means that this stock is just it's more volatile. It's just there's more interest in it. And if the beta is below 1, that means there's just less interest in the stock. There's less volatility. The PE ratio. So this is another stock, really good PE ratio when you're kind of analyzing companies to invest in. I would say for long-term investments, things like retirement accounts and stuff like that, because a lot of the newer stocks, a lot of the growth stocks out there don't necessarily have earnings, and when a company doesn't have earnings, its PE ratio will be there is no PE ratio. So the PE ratio is calculated the price of the stock divided by its earnings per share. So in this case, the PE ratio of Apple is 34. And most people like to use a benchmark of around like 15 to 20 as a cheap stock for a PE ratio. So if a stock is a PE over 20, it's considered a little expensive. And if it's a PE ratio below 20, it's considered a little cheap. But in this example, Apple is a growth tech company. So people are willing to pay more, higher price for earnings ratio. And this is also a ratio that kind of tells you how many years it will take you to get your investment back. So as you can see, a look here over the last 12 months, Apple earned $13 per share, and this current stock price is $450. So it'll take you around 34 years to get back your earnings. So if you were to buy one share of Apple at $450 and each share earns $13, then using these numbers, it would take you around 34 years to get recoup your investment back in terms of company earnings. So that's another way to look at it. If you see the PE ratio is way too high, it takes too many years, it might not be the best investment. But just realize that high growth companies are always going to have a high PE ratio, whereas slow growing companies, things like Procter Gamble and Johnson and Johnson, really big companies that don't grow a lot are going to have cheaper PE ratios. So just keep that in mind. Okay, so the next one is EPS, earnings per share. That is simply the net income of the company divided by the number of shares outstanding. So for in this example, you can see Apple has an earnings per share of $13, and people usually tend to like seeing earnings per share increase over time. It's really a quick way to kind of gauge how much each share that you own has earned is earning you every year. So it's just a quick way and a simple way people like to calculate earnings. And as long as earnings per share are growing over time, people usually like to stay invested. So the earnings date, this is just an estimate of when the next earnings release will come up. This can change depending on the company, but usually they're going to release these numbers. By SEC rules and regulations, they have to release earnings within 45 days of the ending quarter. So this is kind of the range where you'll see earnings. And then the forward dividend and yield. So the forward dividend, this is the annual you will earn per share. So that means if you have one share of Apple stock, every year they will pay you $3.28 per share. And the yield is basically the percentage of the stock price. So it's around 0.73% currently. So usually growth stocks like Apple have much lower yields because the stock price keeps growing. But then you'll see companies with much bigger yields, more, REITs and bigger, slower growing companies, or stocks where the stock price has gone down a lot and that's made the yield go up. So the ex-dividend date. So this is the date, the cutoff date for owning the stock to receive the dividend. So you have to buy the stock a day before the ex-dividend date, or you won't receive the dividend. The other person who you bought the stock from received a dividend. So let's say you bought a share of Apple stock on the ex-dividend date of August 6th. What will happen is the person that sold it to you will get the dividend, and then you'll get the dividend during the next quarterly payout. So what you want to do is you want to make sure you're buying the stock at least a day before the ex-dividend date so you get that dividend payment. And then the 1 year targeted estimate, that's just some of the estimates that they have on Yahoo Finance or sites like that where they estimate what the target price is, where they think the stock is going much higher. So I hope this covers everything on how reading a stock quote. Really basic information here, guys. We're really helpful to use this information to kind of help you, trade better and invest better and figure out, which stocks you can buy. So I hope if you found this video helpful, so be sure to smash the like button if you enjoyed this content. And be sure to hit that red subscribe button and to receive more video tutorials on tools like Yahoo Finance, which I use every day. And also I'll be doing videos on other stock trading apps, things like Fidelity, Robinhood, things like that. So that's it for now, guys. I hope you enjoyed this video. So until next time, guys, take care.